Hello, ladies and gentlemen. I'm Joseph Novichkov, Senior Trading Manager with GDM. Welcome to today's webinar. Our topic today, ladies and gentlemen, will involve the time frames on the MetaTrader 4 platform. Also, we'll have a look at different trading styles. Also, I will give you some examples on how to choose good indicators, basic indicators. And of course, some entry and exit rules. Just a brief overview on what is yet to come. And basically, talking of which, the next webinar we'll have a look at the position sizing rules, and of course followed by entry and exit rules. But today, speaking of different time frames, indicators, different styles, we have to mention a few good indicators, what they're usually used for, how you can combine them, and basically what I'm talking about is that you will see the four type of indicators that all Forex traders must know, in combination of which is by far the most typical, extremely easy to use trading system. Of course, this will not be the absolute topic, but of course it's essential at the end of the session itself. Furthermore, what you see in front of you is a live euro-dollar daily chart, because we will just working on it as we go. If of course there is someone over there that prefers any different currency pair or commodity, we can also use that. So please use the chat below to make your suggestions. First of all, what I'll be starting with is the difference between the time frames. Now, every trader already, whether it's intermediate or experienced trader on the market, knows all the time frames that you can see above, from the range of 1 minute chart to monthly chart. But what is important here, ladies and gentlemen, to stress on is that when you set a particular time period on your chart, it does not show the price over that time period. Rather, than each individual candle takes that specific time to form, as this is probably very close to those that are a long time on the market. However, I can't just pass through and not mention it. As you already know, there are also basic traders. There are some that just come to the market and they have no idea what chart is. Let's take an example here as let's say the 5-minute time frame. A 5-minute time frame does not show the price action over 5 minutes, but rather each individual candle on that on the price chart takes 5 minutes to form. So basically, when we look at a price chart, a large time frame such as weekly chart will show the price range over the course of a number of months, but each candle will take a day or a week to form. So you see, smaller time frames such as the 5-minute chart, however, show the price action over a much shorter range, but each candle takes 5 minutes to form. Or if you're looking at 15, 1 hour, 30-minute, 4-hour chart, daily chart, so on and so forth, every candle forms for the time frame that you actually selected. The definitions of a different time frame, of course, we cannot pass without it. Opinions, of course, differ on what differs a short-term time frame in a long-term time frame. However, a good price to start in order to differentiate between different time frames is to consider that anything below an hourly time frame can be considered short-term. Anything below a daily time frame can be considered medium-term, and anything that is daily and above can be considered as a long-term time frame. Well, that's very good. However, what time frame should we choose? Now, a trader does not need to monitor every single time frame, and that's in order to be successful. And when in previous webinars, I've mentioned that in order for any strategy to work well, you have to monitor all the time frames from bigger to smaller, depending on which time frame your particular system is set. It's good to pay attention to all those time frames, especially the larger time frames than which you actually chose, is because anything like support and resistance levels that are rather big on bigger time frames like significance, that would definitely play major role on your smaller time frame. However, as I mentioned, it's not always necessary to monitor all time frames to be successful. However, a time frame should match the personality of a trader, because there are different disciplines and techniques for different time frames. Someone with a lot of patience that prefers to trade the market without high volatility, for example, may prefer trading on higher time frames. Someone who prefers to trade frequently with a large volatility market may prefer a shorter term time frames, of course. To traders, when you actually compare two traders, they always differentiate one from each other, and a trader should choose the time frame that suits them best. Now, speaking of developing a suitable time, developing a successful trading plan, we cannot go without the time frames. Now, why is that? It's very simple, because when you develop, or you already have a strategy, you are focusing on a particular time frame. But for those that have no strategy whatsoever until that moment of time when you actually start seeking help to develop a strategy, you will need to know the difference between the time frames, the difference between the traders. Also, the most important is the 4 indicators that every trader should know, especially those that are just coming to the market. So speaking of which, starting with the short-term time frames, basically what traders are using the short-term time frames is that the duration of short-term trades generally lasts from several seconds to a couple of hours at most, which means this is the so-called well-known scalping method, in which traders monitor short-term time frames closely and enter and exit in a matter of minutes, which everybody knows that is called scalping. The main objective is to make small but frequent trades here. There are several considerations that should be taken into account when choosing scalping as a trading method. And this one of these is that scalping is very fast-paced, and of course requires a significant amount of attention throughout the day to find and of course execute trades. Extremely well, should I say, well-trained mentality traders should take this under consideration, because complete attention is required through the trade from open to close. Very simple put, because the system that you might want to use when you're scalping requires small take profits and rather smaller stop losses, and in those scalping techniques most of the time any kind of stops and take profits are mental. So basically, you don't really have time to set up take profits and stop losses. You only know the price in which you will exit, and you will stop your losses eventually if that occurs. Now, I've presented past 2 months trading systems for all range of time frames up to daily chart for any kind of trader that might decide to use scalping to swing trading or long-term type of trading strategies. Also, this main topic is quite appropriate to mention that if anyone needs any kind of help to adjust some of those strategies to his particular set of skills, or to initially explain what the type of strategy does, if you have difficulties in understanding in the webinars, please get in touch with us. You know already how to do that at our email address if you have time. Of course, that's webinar at gdmfx.com, and also directly on our brand new website, gdmfx.com. You can always go to the support department and strictly ask them for my attention. That wouldn't be a problem at all. Let's have another point here of the scalping. The technique requires active market sessions, ladies and gentlemen. So this is the most frequently during the London and New York sessions, for example, when the volatility is relatively higher. And what did we spoke about the last time? Our previous webinar was about volatility. So having in mind that choosing a scalping strategy, you need volatility. Our last webinar prepared you to know what volatility is, how to expect it, and what kind of particular indicators you can use to measure that volatility. Speaking of indicators, of course, we'll have a look at a few combinations later, like a type of strategy that you can use on a medium-term to long-term strategy, like from several hours, like 4 hours or a daily chart would be quite suitable. Meanwhile, it is also important to mention that scalping techniques can be extremely stressful, and of course it requires discipline to continuously stick to the scalping system. So basically, you in some let's say if some of you decides to be a scalping trader, let's say more than 2-3 hours of scalping would be absolutely enough for you to generate a healthy profit with a low amount of risk during that time. But then your brain will probably overheat and the mistakes will start flowing in. So my recommendation as a professional, I would stay away from the market after the first 2 to 3 hours of trading, basically because you will have made already about 20-30 position possibly if you have a good volatility, the one that we see right at this moment. Not only because we have some fundamentals coming out for the US, but also mainly because we're about an hour ahead of the US market open, and in that time the market is extremely volatile. So you can see here in front of you, we just saw this for about 10 minutes. For the past 10 minutes, what happened is about 14 pips in size of the euro-dollar chart. That's about $140 of profit per lot, and that's for 10 minutes. So basically, you can see that for 10 minutes you're making about $140–$150 of profit. in the next 10-20 minutes, you will probably make the same amount, or maybe even more. So until the end of these 2-3 hours tops trading, you will probably generate thousands of dollars of profit, and it's not really worth it jeopardizing that profit with reckless decisions. So being a scalper requires a lot of discipline. So even if the market presents you an opportunity that you clearly see a direction where the market is heading, the discipline to stay away from the market because your trading plan says I'm trading only 2 hours today because I'm a little bit tired, or I'll be trading 3 hours because I feel good, I think I can take it. But then making 2-3 consecutive mistakes with relatively large loss would definitely tell you that you should stay away. And even if you don't make any mistakes, that would be even better, but still have that in mind. 2-3 hours tops scalping, and that's it for the day. It's not really worth jeopardizing those profits because until the end of the day, you can do something else. You can go out, you can just see some friends, relax until the next trading day comes. Or if you want to split 2 hours in the morning and 2 hours in the afternoon, that would be how professional traders usually trade. And they probably already know that. During market opens, they generate 2 hours of trading with $3,000 to $5,000 of profit, another profit such as this in the afternoon in the US session, and that's how they conclude their trading day. Basically, after the first 3 to 4 hours, I've mentioned it before, the volatility slows, and it's not really worth scalping if you are a scalper. However, it's important to note that scalping does not guarantee a trader positive returns just because potential profit can be made quickly, you see. This is from the risk point, this is from the risk side. That's why we have day trading or intraday trading. As the name suggests, day trading is a method where orders are opened and closed within a single day, and the positions that are carried throughout that day are not left over the night. So trading can actually take place in 5-minute charts, 15-minute charts, hourly charts, and so forth. 4-hour charts as well. However, 4-hour charts mostly, how to say, suitable for swing traders. They're quite good, especially for following mid to long-term trends. And it doesn't. The day trading, however, as we mentioned, it does not rely as heavy on fast price actions such as scalping. Rather, the day trading is considered before choosing it as a preferred method. So most traders prefer to be day traders. This method is slower than scalping, however, but not as long as other longer-term types of trading, where you could wait for days or even weeks to find an entry. A day trader, however, should keep an eye on relevant economic developments, as these can change the market conditions throughout the day itself. This type of trading is suitable for technical traders that also pay attention to economic fundamentals. Rather than scalpers, they actually place their decisions on price action moves and large volatility indications rather than any economic events. Well, of course, it's very close to understand that those price actions and large volatility events are developed on the small time frames where all of these indicators can actually generate those entries on the back of those fundamentals or some, let's say, technical positions of large hedge funds or central banks moving money in and out. Those economic fundamentals are actually pricing in the market from a technical standpoint on your indicators. And why I'm saying that, it's very important because of the system that I've mentioned some time ago, is a system that is rather scalper system that focuses on 1 minute to 5 minute chart with indicators which you want to find. If you want to find out which they are, you can have a look at the recordings in the YouTube channel. For this particular webinar, if you have difficulties in finding it, I can send you the direct link if you contact me back. But right now, what I want to focus on is the medium-term time frames. It's the midterm time frames. Traders will of course watch the 4-hour or daily charts. Now this is what I mentioned earlier when I mentioned 4-hour charts, with swing trading. So those traders will have to attempt and look at the overall picture, while of course potentially only finding a few trades per week. But those trades carry pretty much larger in size amount of profit. Why I'm saying that, it's because your trade and the trend that you might catch can go on for weeks. So actually not only just a few tenths of pips in scalping profit you might generate, but you might even reach to 1,000 pips of profit that you might generate. Of course, when you combine this with the low amount of stress, looking at the overall picture from above, when you consider much, should we say, a trading strategy which is with a lower risk-reward ratio, which means you are pretty much going to generate less pips in profit for, let's say, 1 month time compared to scalping trading, but you will of course also generate less pips in loss compared to the scalping trading. So basically the things are actually leveled out at some point. The profits that you might get on scalping and the profits that you might get on swing trading in a matter of a month time frame. But what you're actually decreasing here is the stress and of course the comfortability of just following your position instead of sitting in front of your computer and looking for an entry minute after minute. Of course, I'm not saying that I'm not scalping as well. Of course I am. Everyone probably tried it. Professional trader actually deems to change his overview depending on market conditions. So basically right now is very good to scalp. Let's say you can see the euro is dropping. Every time you see a very good entry like dodges like this or inner candles like these, you can always take your profit and then enter another short position. Of course those are tens of pips of profit, which using an intermediate time frame with the suitable strategy can actually generate pretty much the same profit from here to here, which is about 40 pips in size, with of course less profit. So it really depends on the market conditions. You see, you will trade a few tenths of pips of profit, but with a very heavy lot to generate larger profits. Of course, when you trade on a 15-minute chart, for example, for this movement of 40 pips, will of course use half the size of this profit. And depending on those market conditions and the certainty of a direction, you will choose the correct system to trade. However, this is mostly suitable for trained professional traders that have long years of experience and they know how to stay on top of situation from a mental state standpoint. So for those that are trying to find their path, their right way to trade, what I'm going to present to you today involves all the correct steps of finding the best time frame to trade for yourself. I see some questions. It's a very interesting question that popped out here. There is one of our clients that is experiencing some trouble with the screen. I suppose it is possible that the screen has gotten paused by some reason, so I'll just try to reset it, and we'll have just a few seconds here to try to reset that screen. So now it's all reset, and if everything is good, please let me know. And for also, as I mentioned about the questions, I will of course answer those questions to you guys after the session in an email. So yes, thank you, Carol. That's great to hear, because the move in the euro is actually essential to what you're actually experiencing in the webinar. So now you see when I mentioned the entries, let's cover this one more time for those that didn't mention to see what I'm actually explaining, is that the scalping system that you might want to use, you will probably take a few candles of moves for a few tens of pips of profit. Then you will close that position, recover those profits. On a retracement, you will enter one more time. Probably you will exit here, and then you will enter one more time for another 20-30 pips of profit. So you see the amount of pip size in these situations is relatively smaller than the whole size here, because you're actually catching the retracement. You can see here is about 43 pips in size, but when you measure it from here to here, this is 10 pips from the entry to the exit. This is another 20 pips here. Here you have another 35 pips of profit, and of course here you have also 13. That makes it about relatively close to 50 pips of profit. So you're actually gaining something like $100 per lot more in scalping. So it definitely depends on the market conditions for professional traders to decide which strategy to use at a given point of time. But as I mentioned, for those that are trying to find their way, and or they're trying to get back on track from there they lost it, the best way to generate more successful profits, you know, when you draw the line at the end of the month or at the end of the year, it's better to choose a way of trading that it's much more suitable for you. And one of those ways that you might find suitable could be swing trading, as we mentioned. Swing trading is a medium-term trading who, you know, suitable for traders who may look at a daily chart or a 4-hour chart to see underlying trends, and of course decide on specific trades based on, let's say, on 4-hour chart. Positions are generally held from a day to a few days, or sometimes if the trend continues, you might just leave it for the whole week. As swing trading, stop losses and profits targets are generally higher, as we mentioned. When I'm saying higher, that means you are expecting larger pip size in return in a single position rather than the scalping type of trading, or a daily trading, for example, also in compared to a midterm trading. It's interesting because you might have only 2 positions per month, but those 2 positions might generate about $20,000, let's say. You might even have 200 positions over this month, or maybe 1,000 positions. You have no idea how many times you might be able to trade if you're trading on a 5-minute chart. but let's say around the average of 500 positions per day, per month, and your generated amount of cash could be 10, probably 15,000, only because the amount of risk is relatively higher in this particular type of trading, which means more positions goes directly to more risk potential. Less positions, less risk potential, but then it's less stressful, and of course much better to pinpoint those trades by identifying mid to long-term trends. You know, some traders might find this the swing trading extremely suited to their personality or their particular desire to trade. Now, swing trading, however, as we mentioned, would suit those who cannot monitor the market every day. Now, we're talking about some technicals here, you know, but of course can dedicate at least some time to the market for to make the technical analysis, the fundamental analysis, for finding their entries. Also extremely suitable for traders that are patient. They can wait for the correct entries, which may mean only finding a few times per week or a few times per month. You never know. Of course, they trust their trading plan and do not change it every time there is let's say an adverse price fluctuation. So you always stay on point. Now, why I'm saying that? Let's have a look at the 4-hour chart time frame. As we look at the euro-dollar chart, this is the 4-hour time frame. But when you squeeze a little bit in, let's have a look at the daily charts. You will see why. When we place that trend line here, when the first trend actually developed, it was here from this point to this point. It's how you identify it. First. Second of all, when you squeeze it down to a 4-hour chart, you will see that the main trend is not really breached, but rather than that, you have a fake breakout over here. So this particular fake breakout is always considered by traders, because this is just a trend line that you might want to use on your 4-hour and daily midterm trading, which means that you will actually use other indicators, which I will show you in a matter of minutes from now, how you can identify better that the particular trend is still on track. Even if you have a fluctuation such as this one, for example, you wouldn't really care, so you will stay on your plan and you will keep your positions open. Or if you are, let's say, a person that does not take too many risks, well, you have the opportunity to take your profit on the break of this trend line, and then on the re-entry of the downside, you can enter one more time. So let's have a look in Pip Size. When this particular trend has developed on this double top here, let's say, you've entered on the bounce off from this point, and for example, you've exited on the breakthrough, which here is a price of 1.1276. And here we have 1.1111. So that in a matter of week time, you have generated about 60 to 70 pips of profit, and then from here to here, you might be able to generate pretty much the same amount of pips. But this, of course, ladies and gentlemen, would involve larger position sizing. Why is that? You will find out in the next webinar. Right now, we will focus on the final type of trading. This is the long-term trading. And speaking of which, a long-term trader is a very patient trader. Waits patiently for all opportunities that might come. The trades can be rare, of course, and usually held for a long periods of time, sometimes weeks, months, a quarter time, or sometimes even at the end of the year. This particular trader is a position trader. So that means the method involves daily, weekly, and monthly charts. So this particular trading style is called position trading. Fundamental analysis, however, can play a key role in making trading decisions because economic conditions may change over the time for which trade is open. So you see, that's why we spoke 2 months about how to make a successful fundamental analysis. This is suitable for those position traders. Furthermore to that is to add that when you're using also along with that trading strategy, you will always have to go back and reevaluate the quality of this trading strategy on every 3 to 6 months. Simply because during the usage of this strategy, the fundamentals are shifting, and you have to always remember that. If you're trading on long-term picture, on the long-term picture, that means you're some sort of an investor. That would work for you as well. You should always keep in check your own trading plan. Do not overstep its rules, and furthermore to that, check your trading strategy, the technical side of the trading strategy. However, the technical analysis, as we mentioned, is extremely reliable on long-term trading positions because many traders that trades large amounts of money use technical analysis to enter and exit trades, including financial institutions, ladies and gentlemen, commercial and central banks. So you see, having in mind of all the fundamentals during the time of the trade and reevaluate our technical standpoint, your trading strategy from your technical analysis, your technical trading strategy is the best tool that you have on a long-term trade. Because all of the institutions, they mind the fundamentals, of course, but most of all, they trade on a technical patterns, Elliott waves, if you wish. You know, they're using some sort of their own developed strategy, their own developed indicators, if you wish, customized. That's why position trading is suited for traders who have a lot of patience to enter and exit a trade. They're disciplined to refrain from changing the initial plan in setting, and of course are prepared for big price swings. And this is something that I cannot undermine here. It's extremely important, especially for long-term traders. They usually have a very large starting capital because long-term trading account generally has to be able to withstand large losses. So basically, if you have any kind of objective and you know that the price is heading there, short-term price fluctuations can actually wipe your account. So you have to be able to bear the negative trend for some sort of time until the price goes to your objective. So going there, and we have to summarize all of what we mentioned so far, is that in general traders exhibit a wide variety of styles. You see, what we've mentioned on the short, medium, and long term, those are just 3 different time frames, which means in those 3 different time frames, there are more than 6 individual type of traders. as we already mentioned, that they can use different styles of trading that involve different trading systems from a technical point. And of course, not at the last place, the fundamental side of the picture, which in the midterm to the long-term side of the story is extremely important to follow. From a technical standpoint, however, let's see the 4 types of indicators that the Forex traders must always know. Now, this particular side of the story today on the webinar, ladies and gentlemen, is mostly, should I say, suited for basic to midterm traders. However, many Forex traders spend time looking for the perfect moment to enter the market, or some, let's say, a telltale sign that screams the signals buy and sell. While the research can be frustrating, for example, the result is always the same. The truth is, there is no one way to trade the Forex market. Basically, what I'm saying is that you can trade it by many various of ways. However, the result at the end should be profitable, sidelines, or losing. It's like the way the market works. So here today, about the end of the webinar, we will take a look at 4 different market indicators that most successful traders rely on. And speaking of which, it is usually suitable for 4-hour to daily chart trading. So the chart in front of you is for the reason of those indicators, to have a look at them. The first one, the first number 1 indicator, is the trend following tool. It is possible, of course, to make good profits using a counter trend approach to trade. Very risky, however. For most traders, the easier approach is to recognize the direction of the major trend and attempt to profit by trading in the trend's direction. This is where trend following tools come into play. Many people, ladies and gentlemen, however, misunderstand the purpose of the trend following tools and try to use them as separate trading system. While this is possible, the real purpose, of course, for trend following tool is to suggest whether you should be looking to enter a long position or you should be looking for a short position. So to consider one of the simplest trend following methods, the moving average crossovers. As an example, we will have a look at the 50 and the 200 exponential. Look here, I already have it in place. The 50 and the 200 exponential, ladies and gentlemen, is the theory that the trend is very favorable when the 50-day moving average is above the 200-day average, and unfavorable when the 50-day is below the 200. So you see, this is for long trades. However, let's do this and have a look at this extremely long euro-dollar chart trade. This is your crossover with a brilliant evening star formation on place. You can enter the market anywhere you see fit here. Of course, trading on a daily chart, extremely important to remember is to catch the absolute utmost higher position here. Let's squeeze the chart so we can measure the profit. Now I would exit probably somewhere on those swings here. because the market is in sidelines direction already. So somewhere on those swings, let's say around here, that's 2,541 pips for 269 days. You see, that's over $25,000 of profit for 269 days. That's close to 2 years' time. However, this is on one lot position, right? So for about a year and a half to generate, let's say, if you're trading for such a long time, you would probably enter the market with more than 10 lots, like 100 lots or something like that. That's close to $2.5 million of profit for a year and a half. So this is how the big traders are trading. You know, they're catching the trend. They're just along for the ride until that time. Of course, you can normally, you know, how this works is that always when you see a retracement to the smallest moving average, you increase your exposure. Every time you see a retracement, you can short with additional lot size. When you see a bottom, a dip, for example, you can cut those positions by taking those profits. With, of course, an opportunity for additional profit. So this one can result in over $3 to $4 million of profit in a matter of a year and a half, which is a pretty normal profit for any large long-term trader. Of course, this is not only the picture for such a long particular time. However, you can use a different set of instruments. In this case, you can always use the 10 and 30-day moving average. So let's change this into a daily, 10-day, this one into 30-day, and shrink it down to that 4-hour chart as we mentioned. Here we go. I think this one is much better. So you see on the 4-hour chart, you can take a position once a week or twice a week. You can see that crossover here. This is a pretty neat profit of about 172 pips of profit on one lot. As we mentioned, is $1,750 of profit for about a week time. So this is only one lot profit, but if you are still using, you know, this particular strategy, you should be able to take positions with size of about 10 lots, for example, which can generate close to $20,000 of profit every week, or twice a week, twice a month, for example. It depends on the potential of this position. You can see some positions are relatively smaller in size. For example, this one is 100 pips. This one here, for example, could be also 100 pips for about 3 to 4 days. So you see, it depends on the position. On the position profit size, and that will actually tell you what the size of your position should be actually, which we will have a look at the next time. But right now, what I also want to focus on right now is the trend confirmation tool. You see, the trend confirmation tool is extremely important. Let me clear this out. The trend confirmation tool, we need that to tell us whether the major trend of a given currency pair is up or down. But how reliable this could be. As mentioned earlier, trend following tools are prone to being whipsawed, all right? So it would be very nice to have a way to gauge whether the current trend following indicator is correct or not. So you need to have a confirmation whether this particular crossover let's say, is good for you, or it's not going to cross over one more time and reverse to the upside. Something like you see here in this sideways range. You see, one time you have a crossover, another time you have a crossover. Basically, in this whole period of time, the price didn't even change, and it crossed over on the same period of time. On the same price line as it is, and then it goes up and hits your stop loss. So basically, you need a confirmational tool, something to reassure you that you're making the right decision. In essence, in both the trend following tool and the trend confirmation tool are bullish, then a trader can more efficiently consider making a long trade in the currency pair or the commodity or any instrument in question that you've actually decided to trade. Likewise, of course, in both are bearish, then the trader can focus on finding an opportunity to short the pair in question, if that's what you want to focus, and if that's what we're looking at as a euro-dollar chart. Of course, one of the most popular that are used and are actually useful to use, that actually works, among the normal indicators from the MT4 as a trend confirmational tool, is known as the moving average convergence divergence. Now, we spoke about it many times. We've actually reviewed the MACD, so-called MACD. Basically, the moving average convergence divergence tool first measures the difference between two exponentially smoothened moving averages. This difference is then smoothened and compared to moving average of its own. So when the current smoothened average is above its own moving average, then the histogram is at the bottom. Let's have a look. This is how the MACD looks like. I've actually changed the color here. It used to be green, but it's irrelevant what the color is, as long as you, ladies and gentlemen, see it well on your screens. If you find it difficult to reflect on the darker background, please let me know so I can choose a different coloring on this indicator. As you can see here, on that particular crossover, we can see that when the moving average crosses, our histogram is below the zero level. So this is our confirmation that we have a bearish signal. Now, let's have a look at this situation here. You see, when this bearish crossover of those two moving averages occurred, our histogram is still above our level, and it starts hovering around it, which means it's a clear sideways direction, and we cannot enter. Of course, what we can do in this time, if we have no entry on the euro-dollar, use it on a different currency pair, use it on a commodity. If you wish, use it on an index or whatever that you want to trade on the MetaTrader 4. So this is how we confirm our trend. And please, ladies and gentlemen, if you find this that you already know it, that would be very good, because refreshing your memory is always something that I'm glad to do. In basic explanation, these four indicators that I'm presenting to you today are by far the easiest, the most efficient trading system on a midterm level. And of course, you can extend it to a larger scale, as I showed you on a daily chart, which you are actually making your decisions on a daily chart of direction and picking your best price action on the 4-hour chart. That's also something that I had to mention. Number 3 indicator, where using all those that you see in front of you so far, you need to have an overbought and oversold tool. Now, traders are typically well advised to trade in the direction of the major trend. Of course, every trader must still decide whether he or she is more comfortable jumping in as soon as a clear trend is established or whether a pullback will occur. Now, why I'm saying that? You see that we have a clear crossover here. It's very easy to see. But then in 2 candlesticks after, we have a pullback with about what is that? 56 pips. So along that time, before the trend starts appearing in your current direction, you will be bearing a loss of $560 per lot before you actually start getting in a profit, and that's 4 hours. And you see your entry is here, then the price is fluctuating somewhere, and then you're actually bearing another 4-hour chart on a negative trend, which gets you thinking, have I actually made a right decision? Or it's actually another sideways direction? Then you should, as well as use an overbought and oversold tool, to find a better entry, so you can always stay on the positive side. I'm not saying that you will always be able to stay on the positive side, but at least you can try to make it as thin as possible, the difference between the peak before the fall, in this case, for example. In other words, if the trend is determined to be bearish, as we see it here, the choice becomes whether to sell into strength or sell into weakness. That's as simple as I can explain it. So if you decide to get in as quickly as possible, you can consider entering a trade as soon as an uptrend or downtrend, in this case, occurs or is confirmed by our MACD. On the other hand, you could wait for a pullback within the larger overall primary trend in the hope that this offers a lower risk opportunity. I hope that makes sense. For this, a trader will rely on an overbought oversold indicator. There are many indicators that can fit this bill. However, one of these, which is by far the most useful to me personally, that's why I'm giving it in a combination, is the from a trading standpoint, is the RSI. The indicator calculates the cumulative sum of how many days up and how many days down over the window period, and calculates a value that can range from 0 to 100. Now let's have a look how it looks on the chart. I suppose most of you have heard about the relative strength index. Also, along with that, it's a good tool to use. The stochastic oscillator, however, it has 2 lines, and when you use the stochastic, you might want to use only one of the lines, but pretty much because it's not necessary, and basically because it's much slower than the relative strength index. With a combination of 4-hour to a daily chart, your relative strength is much better. Which means that in an example, a reading of 50 is considered as neutral. That reading will give you this sideways range where you will stay away from. Basically because the relative strength index is used to trade ranges, you will know that when it's in oversold or in overbought conditions, that you have a trend that it's establishing and it will continue. Also, the period of this indicator. Now, I found out that for longer time periods, for longer time frames, it's suitable to use from 10 to 14. Some use up to 20. But that generates a little slower confirmations on these trends. So I prefer to use the middle as a 14, which is a pretty good indicator. Of course, in here you can establish your 50 level in addition. So let's put it in and have it as an additional level to our RSI. It's over here. Have a look at this timeline. We see that on the breakthrough, on the crossover here, we see our moving average starting to expand. We have decided to take short positions because our MACD is in negative territory. After that, you know, on the moment of this crossover, we see about 37 level of relative strength. We will, of course, wait for a slight pullback towards the 50 level, and we see that a resistance is taken around this 30 moving average, from where we might be able to enter a proper position for as long as 235 pips of profit. And that's the optimum. However, the total profit that you might generate, you will also need a profit-taking tool. First, we have an entry, we have a confirmation, we have a direction, and then we have the profit-taking tool. This is the last fourth type of indicator that, ladies and gentlemen, all traders need to know, is something to help determine when to take a profit on a winning trade. Here too, there are many choices available. You see, someone might have a different idea on how he prefers to take its profit, you know, their profits. In fact, the RSI can also fit into this particular category. You can see that when the price enters below the level of 30, you can always take your profits. However, this is somewhat better because you have it all right in front of you. But I would also suggest another way to take your profits with another useful profit-taking tool. It's extremely popular indicator. Everyone knows it. It's called Bollinger Bands. This tool adds and subtracts the standard deviation of price data, its changes over a period from the average closing price over the same time frame to create trading bands. Now let's have a look at it. I'm not going to go into too deep explanation. Everyone already know it. And the normal, let's say the more suitable period of time for the Bollinger Band is to take about period of 20. I've preset it for you. This is how it looks. And basically, a trader in this case holds a short position until the profit-taking tool, in this case the Bollinger Bands, reaches, you know, the price reaches the lower band, and that would be somewhere in this range. You can see how the extension, let's shrink it so we can see it much better here. You can see how this particular band starts going higher towards the upper band and the moving average in between. Then you should look for the lower range, lower band to exit your trades. And this tool will actually allow you to take as much profit as you can get of these positions when you combine it this way. The bottom line is, this is just an example, ladies and gentlemen. I'm not recommending anything to anyone by saying this is extremely profitable strategy. You can always use it, and you can you say 100% rely on it. I'm only saying you can rely on it about 80% because nothing is with a 100% certainty on the market. There are always fundamentals that are shifting and that can actually crush your trading strategy at some given point of time. Now let me show you why. Take a look at this ridiculous 4-hour chart gap on the euro-dollar chart. Now this is overnight during weekends because the Greek government failed to reach an agreement. And of course, this particular moment with relatively the same size occurred in most pairs and commodities as well in that case. So nothing actually works in this case because what you can see is a bearish opportunity because the RSI is telling you so, the MACD is in negative territory, your moving averages are properly aligned. However, the price retraces 100% hitting your stop loss, which is of course somewhere here. Why there? Of course you will set it up at the nearest appropriate group of candlesticks a few pips above its shadows. It's the most suitable way of doing it. However, it's just a recommendation of my own. Some of you might decide to choose larger stop losses. Me personally, I wouldn't take a risk larger than 200 pips, which is in this case even too big considering the 4-hour time frame that you're using. Of course, if you're using a daily chart, on the other hand, that would be relatively different in this case because your decision is already made a long time ago and you were just pretty much out of this pair for as long as somewhere over here in this case. It's very important to understand when the market is entering sideways direction, and you can see how the price is confined between this and this level for a very long period of time. So you don't really need those price swings. You better exit because from those cases, somewhere around 30% trends are reversing up, looking for a 100% retracement from your entry, which is somewhere here, and about those nearly 3,000 pips profit will be lost. With that, today's session is concluded. I will be very happy if I helped you guys to understand the next step of finding and developing your personal successful trading plan. The next time we will have a look at the rules of position sizing. This will be our next step on finding out in these kind of moments of opportunity where how big your position should be. With that, thank you very much for joining us today, and I'll see you next time. Thank you. Bye-bye.